As we've been telling you, it is the week for retail earnings. April retail sales first come out tomorrow, and then big name brands open their quarterly books. Economists are predicting, at least for retail sales, that shopping, restaurants, other retail outlets rose 0.8% in April. That's month over month, and that would actually match the March increase. But it's half the increase reported for February. The data point comes as big names from Walmart to Target, Lowe's, and a whole bunch of others release quarterly results this week, giving investors a gauge or a window into American consumer sentiment. Many of the companies reporting work with Affirm. Shares of the buy now, pay later lender actually got a boost late last week after the company reported a narrower than expected quarterly loss. But quite frankly, the stock has seen 75% chopped off this year to date. So right now, Affirm down about 3%. It was actually higher earlier. Let's bring in Max Levchin. He's Affirm's CEO and co-founder. Max, let's get to the consumer ahead of the big numbers tomorrow. How are your customers shifting or maybe slowing their spending as we continue to see persistent inflation at 4-decade highs?
So I think inflation is definitely on people's minds. I think it's now a very, very aware topic. Folks are coming to us, frankly, to help them regain some of that spending power that they're losing because of this decades high inflation. There's also a very clear rotation of segments, if you will. Connected fitness was older age this time last year. Today is definitely not the fastest growing segment. On the other hand, there is a 120% year-on-year growth in travel, which is both understandable and I think heartwarming. People are finally getting out of their lockdowns and traveling.
Yeah, I remember in the beginning with Affirm, I believe that a third of your revenue came from Peloton. That was one of your very first partnerships. And obviously, we know the situation with Peloton is shifting as well. We are going to get retail sales tomorrow. I have no doubt consumers are spending. Your full year gross merchandise value of what, $15.14 billion shows that. But consumers are notoriously behind the 8 ball when it comes to reading the writing on the wall. And if you read the writing on the wall, including, Lloyd Blankfein, formerly CEO of Goldman Sachs, we're heading for what could be a recession. How would you at Affirm prepare for something like that?
I think it's definitely on the minds of every CEO out there, especially in the payments business. We track all of our consumer behavioral data, especially, but by that I mean repayment data. And to date, there's really not been a disturbance in the force, if you will. But a core tenet of our business design, if you will, is we don't lend money if we do not believe the person borrowing can pay us back. That's sort of the cornerstone of things like not charging late fees, not doing deferred interest, all the sort of yucky stuff the industry is infamous for. It's all about hedging your bets vis-a-vis, well, maybe this consumer is not okay, but we'll make money on them anyway. We only transact with consumers we genuinely believe through our underwriting models will be fine paying us back. And as recession causes people to lose their jobs, et cetera, that is when I start worrying. To date, America is fully employed. I think consumers are spending money they're earning, and prices are going up, and the Fed is trying to do something about it. But fundamentally, vast majority of the folks borrowing money from Affirm and beyond are very well employed and capable of paying their bills.
Well, that's good to hear, but this is where I worry. We were in an atmosphere of free money, easy to borrow, very low interest rates, near zero. Somebody pays the merchant, that would be you, in exchange for the buy now, pay later. The problem is when the cost of capital goes up as rates rise, you're shouldering that. I know you have a whole panoply of different ways where you fund, but have you modeled for a meaningful jump in interest rates and how you will be able to service the loans that you owe or the debt that you owe?
Absolutely. And that's certainly front and center to a lot of our planning. We are very, very, very prepared for all sorts of eventualities. We obviously track the curve. We are very careful about both the scenario planning of what the Fed might or might not do, but without sort of diving into extreme minutia, like how do you hedge interest rate change. We are well prepared and manage the rates that we pay as we borrow so that we can lend.
I know in your quarterly report you announced that you're expanding with Shopify. We just spoke with the president of Shopify last week. They love their partnership with you, but where else does this opportunity go? And can you meaningfully assign a number to your bottom line that would come from the Shopify deals?
I think it's probably a bad idea for me to disclose numbers that we don't talk about elsewhere, but we love our partnership with Shopify. That's the right verb to use, really. They've been an exceptionally great partner to us, and we'd like to believe we've paid them back similarly. This particular expansion is really cool in a sense that we launched a year ago, and we really only delivered one product to them, which is this really short-term, paying for 6 weeks, really, really simple product. Works great for beauty, for fashion, less expensive products. There's lots of other stuff that people sell on Shopify, anything from really exotic plants to all sorts of hardware people manufacture in their spare time. Those things cost a lot more money, and a 6-week repayment cycle just isn't long enough. And so we're finally bringing to Shopify sellers all sorts of terms that they can offer to their shoppers. And so we expect a meaningful contribution to the business from that over time.
Max, I know that it's been a very rough time for many companies. Obviously, even the Apples of the world have sold way off. We're seeing a lot of discounted shares elsewhere. But when you guys went public, I believe your market cap was around $25 billion. It's at $5 billion right now. How do you engage with investors who are lifting their shoulders and saying, what do I do, Max? What is the answer? And when do you foresee something like this solidifying and turning the stock around?
You know, as one of the largest, perhaps the largest individual shareholder of this company, I am extremely aligned with my both retail and institutional investors to see the stock go back up. I think that's probably the best conversation opener I've come up with. The only way I know how to do this that is independent of market cycles and sort of disruptions that we've seen plenty of in the last few months is just continuously delivering great results. You know, the thing that I can tell my shareholders is, look, over time, it is a weighing machine, not a voting one. We will continue delivering on all the promises we make, and over time, this will be rewarding to us and to you.
Yep, it's the one problem with going public, right? You got to answer to these shareholders on a quarterly basis, and things take a long time.
I love my shareholders.
I know, I get it. Max, good to see you. Thank you very much.
Thank you for having me.